I'm with Vista Ventures. Vista Ventures focuses, we're a regional venture fund, so we like to invest in the region. And we do that because we love early stage. And early stage has always been a local business. I mean, the Bay Area kind of forgot about, people don't think of the Bay Area as local, but they are local funds as well, because to do really good early stage, somebody needs to be close to the company. And what we like to look at, first of all, is where are their core competencies in the region? Because if there's a core competency, you have a higher probability of building a leadership company. And we have to build leadership companies not in the region, but internationally. So we look at core competencies of the region, and they include things like obviously networks, communications and storage, software, and a category called data and media services. And that could be, internet media, but also when you think about data services, companies like First Data, there's a lot of companies like that that have been in this region, and so those are the things that we focus on.
I'm Jason Mendelson with both Mobius Venture Capital and the Foundry Group. Mobius has offices in Palo Alto and Boulder. Foundry Group is a subset of the Mobius folks, raising a fund here in Boulder. We're going to do a third of our deals as we've done in the past in the Colorado area, a third in California, and a third everywhere else. But I'm happy to say not India and China, that we've done a lot out of the Mobius fund, because, well, that will make you turn your hair as gray as mine. We like you, we love to do early stage stuff. I think, the presentation that we saw up here is completely not applicable to most everything that we do. That was big company private equity, and it sounded really cool and neat, and the guys had great ties, but that's not what we do. I'm not going to go on for 2 minutes. Here you go.
Chris Scoggins with Sequel Venture Partners here in Boulder. Like these guys, we do early stage. We are primarily focused in the mountain region. We opportunistically look at some stuff out of region. We do about 2/3 of our deals in information technology and about 1/3 in life sciences. And we'll probably get a lot of questions around, what does early stage mean? That definition's changed a lot. And while we do some seed deals, we primarily do kind of first institutional Series A deals.
Derek Pilling with Meritage Funds. We're a communications-oriented family of venture capital funds. We've got a little over $570 million of capital under management. We tend to do two types of transactions. The first are early stage. We'll actually do pre-revenue, seed-oriented transactions in our portfolio. We've got a program we call Fast Start that is specifically intended for that, where we can put up to $1 million into a company on a very quick, sort of short diligence cycle basis. More traditional venture rounds on the A side, early stage, are $3 to $5 million for us. The other type of thing we like to do are what we call complex transactions. I hope nobody in the room ever has a need for one of those. They're tough deals. They're recaps, restructurings, turnarounds, spin-outs. They're deals that take a lot of operational talent to bring to bear to fix a broken company. And the real differentiation for our firm is that we've got 4 guys on our team, which are serial communications industry entrepreneurs, that sit on boards of directors for us. We don't have traditional venture investors sit on boards. We have operators sit on boards on our behalf. And we think that model works pretty well.
So our fund is called Lacuna. And if any of you are brushing up on your Latin, you'll know Lacuna means a gap or a missing space. And we sort of let the market tell us where to invest. The market sort of told us that there was a gap between angels and VCs in the Front Range region. So we've identified the $500,000 to $3 million gap as the area we're going to focus on. We're 5 partners. None of us have come from venture capital, though 2 of us have come from investing. 2 of my partners came from Goldman Sachs, where they were actually brokers and stock pickers, and very, very successful at it. Over the last 6 or 7 years, they've been running a syndicate of angels. I met them on the board of At Last, which was a local company, made a product called SketchUp. And we ended up selling the company just about a year ago to Google. And so one of my partners was the former CFO of the company, J.K. Hullett. The other was the original funder, Raleigh Rawls. We have 2 other partners, one of whom was a partner of Raleigh's in a hedge fund and at Goldman, and then another is Wink Jones, who was CEO of a local company here that also sold last summer called Net Identity. My personal background is I've started 2 companies, CEO'd them both. One was an operationally intensive company. I ran hotels and restaurants on the Jersey Shore. The second one was a brand strategy firm called Keziah, had offices here and in New York City, and we worked with, just name it, a huge group of very large Coca-Colas, IBMs, General Motors, Kellogg's, people like that. So what we bring to the party is, first of all, a passion for very, very early stage. But we also bring a lot of operational expertise as well. Sounds like you guys bring the same type of expertise. But we do like to get deeply involved in the very early stage and help companies really set their strategies and help them flesh out their teams as well.
Since I've been investing here since '92, I guess I have the most historical perspective. Like a lot of things in venture, everything goes in waves. There was a time when it was easy to bring VCs in. I mean, during the bubble, everyone was putting lots of money. People were coming in without, even local leads. And then after the bubble burst, everyone went back and stuck to their knitting, and they stayed, in their home territories and cleaned up their own portfolios. And a lot of the deals we did in the 2000 to 2002 timeframe would be syndicates amongst the locals, because it was very difficult to get outsiders because they were just busy cleaning up their own messes in their portfolio. And then, it got back to, especially when the three coasts, when things get really hot there and prices start going up, then some of the funds want to come across the mountains again because the pricing here is good and you can get good quality companies. So I think it goes in cycles. At least that's what I've seen for the last 15 years.
Yeah, the one thing I'd add is 10 years ago, people didn't think Colorado had management talent. You had good technology people. You didn't have COOs. You didn't have CEOs. You didn't have VPs of sales. Mm-hmm. I think there's been enough turnaround and turnover of companies that management talent now exists. So outside VCs say, you know what, we can run a company out of Colorado and not have to either bring them to California or import an entire management team.
This is actually like core part of our strategy at Sequel is to syndicate all of our deals. And so we're very proactive about this. And if you look at just the aggregate numbers, Colorado imports about 80–85% of its capital and has for the last 10 years. And I don't really see anything that's going to change that. I think about $550 million was raised in Colorado last year, give or take. And that seems to be about steady state if you take out the bubble. And most of that capital comes from out of the state. So we as a firm, when we find things, again, because we focus locally, when we find stuff, we definitely try to go out and find partners. And we've been pretty successful at doing that. But again, we work very hard at it. We're very proactive about it.
Yeah, I think the bar is always going to be higher here for out-of-state VCs to come in. And it's a pretty simple reason. Venture capitalists are lazy. Okay, the California guys and the East Coast guys don't want to have to get on a plane because there is so much local deal flow. They can literally go 2 blocks away and see a great company. So the bar is always going to be higher. I think some of the issues around management talent persist in this market because whether it's reality or not, it is perception. And it takes a long time to change that perception. We sort of look at this, and we call it the valley of death, and it's the B and the C round of financing a company. And we've always felt and continue to feel it's very difficult at those rounds to bring in outside capital to a company. And so we tend, and you as entrepreneurs may want to consider, try to build syndicates early for your investments that can support you through those growth equity rounds. And make sure that your investors have reserves available to participate in those rounds because it really is very difficult to bring in new investors from the coasts here locally.